Welcome to the Investor Coaching Show. Here's your host, Paul Winkler.
All right. This is the Investor Coaching Show. I'm Paul Winkler. PaulWinkler.com is the website. Educating on investing and financial planning topics. So, if you look at the end of the quarter, I like to look at just what has happened over the past 3 months and just what's going on in the world of investing. It's interesting that the area of the market, this wasn't on my radar screen. I hadn't been watching it that closely, but the area of the market that had the highest return in the last quarter was an area of the market I don't think I've ever seen this asset class in a 401k. I hold it in mind, but I've just never seen it in anybody else's. Emerging markets value stocks, actually the top asset category. Just interesting. And you look at that market segment right now, according to Morningstar, those stocks are still selling for only 86 cents on the dollar when you look at price to book, 86 cents. So, you look at, when I look at a company, I look at prices. I look at what price they're selling for compared to their assets, the book value, my assets minus liabilities. And that just gives you an idea of what's going on. It's not a predictive thing. It doesn't tell us, oh my goodness, this is lower than this one. It's going to take off or it's going to do better. Not why you look at it. It's just how you determine whether it's value or not. And, value stocks outperform growth in 96% of 20-year periods. So value outperforms growth way more often than, it's just not random. It's just historically we look at it and it doesn't matter what area of the market as far as country goes, whether you're looking at Japanese companies or if you're looking at German companies or French companies, and you see this phenomenon where value has historically done better than growth over periods of time, longer periods of time. Now, over shorter periods of time, growth can do better than value. Absolutely. That's why we diversify, because we just don't know when that's going to happen. But these things are selling for 86 cents on the dollar. That's versus the S&P 500 at 425. So S&P 500, very, very high price. So what we're looking at there is what's the potential when we're looking at growth potential. Now, over the short run, we wouldn't expect, that we would know. We can't know what area is going to do better. But here's the reality. People chasing markets have a tendency to go after what did well recently, and big U.S. companies had a recent run-up. But right now what's going on is just mind-boggling. I was looking at the 3 top holdings for the S&P 500. Let's say if you got a fund investing in the 500 biggest companies in the U.S., well, you think, well, that's diversified. 500 companies. That's a lot of diversification, right? Well, actually, Microsoft makes up in an ETF, an S&P 500 ETF. I'm just looking at iShares one. It makes up over 7%. One company makes up over 7% of the index. Over 7%. One company. The next company, NVIDIA, because they traded places. They were back and forth. NVIDIA was biggest for like a little bit, and then Microsoft came back and NVIDIA dropped down. But 6.74%. And Apple, 6.55%. So add those 3 together, over 20%. Over 20% of a 500 company index. And 20% of the companies would be 100 companies, right? 20% of 500. But if we look at this, we look at just 3 companies are 20%. And you go, wow, man, what happens when those companies aren't necessarily doing so great or they're not knocking the lights out? Because companies are selling for really, really high prices compared to their book value and compared to their earnings. I mean, it's really skewing the S&P at well over 20. Historically, the S&P is about 16. And, that's the problem that when I talk about indexing, that's the problem I always refer to. But I just think it's interesting to see that, the area of the market that had the best return in the past quarter wasn't that. It was an area of the market that most people don't actually have. So, speaking of 401ks, I noticed that there was a little bit of research being done on how much people are saving. Apparently, this is something I've talked about over the years, automatic enrollment in 401ks. If you can just automatically default people to enrolling in 401ks. So when you go to work for a place, you show up and you go, hey, I'm here. Let's get to work. And they automatically enroll you in the 401k at a certain percentage of your income. And what they found is that people don't miss it. So that's why I always tell people, just start saving. You're going to find if you just start putting money aside, if you don't have a 401k at work, just start bank drafting into something, just savings. And what happens is get yourself in the habit of saving, and you will typically find that you don't miss it. But that has been the rule more than anything is that somewhere in the neighborhood of 6% is what they're finding that people are contributing to 401ks. And they're just automatically enrolling people. And it has been a very effective trial. I said especially for millennial and Gen Z workers, and they've opted in from day one, and now they found that like 60% of companies automatically enroll new hires. And participation rates, and that's bringing up the participation rate, which is really promising, up to 82% of eligible workers. 82% of eligible workers are actually contributing to their 401ks. So bravo, way to go, guys. Another thing that I was going to talk about here too is there was something about, from time to time I hear people talking about Roth IRAs, and I have to reiterate my position on these types of things because I'm not against Roth IRAs. I think that they're great in many instances, recommend them for a lot of clients, but sometimes I see stuff being written about them that is just plain it's a bit misleading in my humble opinion. There was an article in the journal talking about how to get more dollars into tax-sheltered Roth accounts that caught my attention this week. And it said that everybody with Roth accounts loves them. They were interviewing people, and this one person is a CPA financial advisor and apparently does both roles, which is, boy, I wouldn't want that. But anyway, there's too much to know, and they're very different disciplines. But anyway, they said here that there is a lot of interest in Roth IRA accounts. Everybody loves them. This person says they're like sacred money. But getting there can be tough, says this CPA financial advisor. The main barrier to funding Roth IRAs and 401ks is paying taxes on the dollars going into them. Now, this has always been the issue that I point out to people. Everybody loves them because they don't have to pay taxes on them ever again once the money goes in. But you got to remember, you got to pay taxes on the way in. And if you're, let's say, let's just use a 25% rate just because, keep the math easy. I don't know if it really matters much what rate. You got 22% bracket, 24% tax bracket, but let's say it's just 25. And you put $1,000 in and you go pre-tax. The whole $1,000 gets invested in the account. If you go Roth, now you're down to $750. You got to take the haircut for the taxes. And then you put the money in, and then it grows without tax. And here's the thing, is you look at that and you go, well, wait a minute. Now I have money that gets paid out in taxes that is no longer there to earn income for me ever again. And, you look at that and you go, well, wait a minute. That is pretty painful because now I have to pay those taxes and I can't have any earnings on that money into the future. And I have to be very, very conscious of that. It reminded me of, everybody loves this stuff. Everybody loves them. It's sacred money. Well, everybody loves being thin and exercising, but eating less stinks. And moving more and exercise, everybody loves being thin, but exercising and eating less is, it's just terrible, right? It can't be fun. Well, that's the non-fun about Roth IRAs. You got to pay the taxes first. And those taxes are money that could be earning money for you in the future. And, what you have to be conscious about is that what is my tax rate right now? And what is it likely to be in the future? Remembering that if you're married in retirement, as the tax law stands right now, you got about $30,000 of income that you can get, and there's no taxes on it whatsoever. So recognize that you may put the money in, avoid that you may pay taxes now only to avoid a 0% rate in the future. So that is a problem. It could be a lot better if you put the money in, you don't pay taxes on it now, therefore more money remains invested, and then in the future, when you're pulling it out, there are no taxes on it. That is something to love. Now, what is the right answer to this? Sometimes it's doing a little bit of both. But in this article, what they're doing is giving strategies and saying, well, here's what you can do. The saver can move the dollars from the employer's traditional 401k, that's the pre-tax, to the Roth option. And that, you look at that and go, well, wait a minute. I have to put that income on top of my current income. Because we're talking about you're at the employer. You're working for the employer. Now you're converting it while you're at the employer. That may not be the best thing in the world. And I've heard financial advisors get this wrong where they talk about, convert it because you'll pay, $2,000, $3,000 in taxes today, and then you won't have to pay taxes, $10,000 or $20,000 in the future. But they're forgetting that the money that you pay in taxes is no longer in the investment account and could be significantly more than what those taxes would have been in the future. Especially, and here's the thing, here's what you look at is what tax am I avoiding now versus what could I be taking it out in the future? And you really don't know for sure, but there are educated guesses, and you can take educated guesses as in looking at it and going, well, I'm in a really high tax bracket now. I'm only 10 years from retirement. And, typically people earn a significant amount of income in retirement that's tax-free because of standard deductions, itemized deductions. And the likelihood that I'll be in a higher bracket isn't great. Let's say if that's your situation, well, that's when you make the decision to not convert, if that's the case. So, watch for these types of articles. I see this kind of stuff and they go, hey, that's exciting. Let's just go convert everything. A lot of times I've had people do this. They get to retirement. They, between now when they retire and when they start taking Social Security, they maybe live off of non-qualified money. Maybe they sold their house and they bought a lower priced one and they came up with a bunch of cash there. Or maybe they had non-qualified assets they inherited, which is just taxable assets. It's not in a retirement account. They can live off of some of those assets. This is a strategy. Live off of some of those assets because you don't have any tax consequences. Your tax bracket would be incredibly low at that point. Then you convert to Roth IRAs at that point. And when you're converting at that point, you're paying next to nothing in taxes. You can do that where you're paying next to nothing in taxes, and then it'd be tax-free forever. But in this article, they're talking about doing it while you're working. Just usually not a great idea. That's not, unless you have a really bad income year, it's usually not a great idea to do that. So I very rarely would recommend something like that. So, strike one in this particular article. And then, then they were saying, this is a great way to get more tax savings into a tax-free bucket, says this one person. And I'm like, no, don't talk that way. You need a qualifier here. Anytime they're saying this is a great way, just go, wait. What's the qualifier? It could be. It might not be, though. There's potential for it. You better be careful. This says employees who want to do these conversions must work at companies that have this ability to do that. About 40%, most of them don't do it, about 40% do. But then the other thing is just looking at having an employee roll funds out of a 401k into and they call this an in-service distribution. This is one of the other recommendations, is to do that. In-service distributions, maybe you can do it. A lot of times you will find employers don't have that as an option, where you can roll your 401k out of the employer's plan, roll it out of that, and put it into an IRA separate from the 401k. You usually can't do that. So a lot of times what I'm telling people when they come in and we're doing financial planning for them, they listen to me talk about investing and how I approach investing. And they're, can I do this with everything? Can I do this with my 401k at work? And I'm like, maybe not. Usually not, though. But you can look into it. That's called an in-service distribution. They happen to bring it up in this particular article.